It's been exactly a year since Silicon Valley Bank collapsed. Why smaller US banks are still having issues.
It's been a hard pill to swallow, but the regulators are the referee and they have to be careful on capital. We need more liquidity. Liquidity was the problem with the Silicon Valley Bank last year. They weren't prepared. That the large banks, they really need to stay kind of in their lane.
It's Monday, the 11th of March, and you're watching Markets with Madison. It was exactly this time a year ago that we flipped this entire show to cover the collapse of Silicon Valley Bank. I remember speaking to New Zealand entrepreneurs in the US who were told by their venture capital partners to pull their deposits from SVB before it ultimately ended. Turns out it was the first of a few. 1 year on, and some other regional US banks are still having solvency problems. The story of New York Community Bank is the very latest. The parent company of New York's Flagstar Bank rushing to raise $1 billion in capital last week to shore up its finances. It's one of America's largest regional banks and was the one that saved the failed Signature Bank when it collapsed last year. Signature was one of three in need of rescuing. First Republic also failed and was purchased by JP Morgan Chase, while the infamous Silicon Valley Bank was acquired by First Citizens. SVB kicked off the whole crisis. In March 2023, its customers lost confidence in it, withdrawing $42 billion in deposits in a single day. The run on the bank sent its cash balance negative. Since then, under First Citizens ownership, SVB says it's restored some confidence with $38 billion back in deposits. It says 81% of its clients pre-collapse still have active accounts. But it's nothing compared to the strength of the big US banks. The names that dominate are well known. Under them, there's 4,000 regional and community banks. And as analyst Chris Marinac told me from Atlanta, they've now got new problems. Chris, thank you so much for your time. Really appreciate you taking the time to talk to me.
Sure, my pleasure.
Exactly almost 1 year since Silicon Valley Bank collapsed, and now we're getting news of a rescue package for New York Community Bank. Explain to me the issues that have happened with NYCB this time around.
Well, NYCB has been through a business plan change the last couple of years. They've wanted to diversify both their loan portfolio and their deposit base. That's why the Flagstar transaction in 2021 made a lot of sense. It took the regulators forever to get the deal approved, but it finally happened in December of 2022. And then about 4 months later, they were catapulted into the driver's seat of bidding for Signature Bank because Signature Bank failed on the 12th of March. So effectively, the company became a little bit of the cat that caught the car in terms of a winning bid with the FDIC to get the Signature assets. They handpicked the deposits and the loans they wanted, which was a good thing. They turned down a lot of multifamily loans. They really got a great deposit base. They simply had a lot of integration to do very quickly from late March through December of 2023. At some point along the way, there was the realization with the regulatory bodies, particularly the OCC, that they had to stress test their loans. And those loans being stress tested were going to really struggle in certain circumstances if either the market rate would be reset for those multifamily loans and other loans, or you simply would take the market rate and then went another 100 basis points or so higher. All of those loans became struggling under debt service coverage. And so by regulatory kind of guidelines, you have to put more reserves against those loans. Number one, you have to criticize those loans or call them a non-pass, no longer pristine loan. And that is the recipe for a bank to kind of address credit risk. It was not a matter of loans who were non-performing. In fact, all of them were performing as agreed. They simply have a lower debt service coverage for higher interest rates. And so a lot of those loans were done in 2020 and 21, even before. And so they were done at lower interest rates and in different times and circumstances. And, the better way of even taking a technical overview like I just gave you is that they also had to become a big bank. They really went from the minor leagues to the major leagues as large national banks go. So NYCB effectively had to change its loan loss reserve to come up to peer levels. And the peer group changed. They had one peer group that was more mid-sized, mid-cap banks in the US. Yes, they were unique in being a multifamily lender in New York City, but their loan experience for years and decades was actually really clean and very low losses. When they change to $100 billion bank, it doesn't matter how great the history has been. What matters is they're being compared against PNC, Truist, Bank of America, Fifth Third, other large national and super regional banks. They had to have a peer level of reserve. I think the management team thought they had time to transition, and they were mistaken. The OCC and the Fed asked them to make that change at the end of the year. They were going to be judged for the stress test coming up in April of this year, and they simply had to pivot their business plan very, very quickly. It was a shock to all of us that they didn't have more time to transition. I'm the first to say that I got it wrong as an analyst. We all had to kind of rethink NYCB. I think the challenge for the last 36 days as the stock has struggled has been, what are the level of loan losses and what is the confidence level in the company? I'm comfortable that the loan level losses are less than people perceive. I think the confidence in the company is also less than folks have perceived. And that's kind of how we got to this ongoing saga of the stock price struggling and a lot of misinformation and things taken out of context. But unfortunately, as they say, it is what it is.
There's no real excuse for internal error when it comes to these regional banks, though, is there, Chris? Because they've had a whole year since, as you mentioned, Signature Bank, First Republic, and also Silicon Valley Bank to check out all of their loan loss provisions. And it seems like this one failed to do that, even post Silicon Valley Bank.
Well, it sure has been a strange situation that the regulators gave them the bank of signature assets last March, and there has been no real discussion about how they were going to transition to a bigger bank and also sort of requirements of a bigger bank. I mean, the company took a $2 billion gain for accounting purposes when they bought Signature. There's been plenty of money around for them to do this. And I think we all thought, and we were wrong, that the company had time to kind of determine, where it was going to go. I mean, the loan loss reserve under CECL accounting, under GAAP, is supposed to be a function of what you expect to lose on the portfolio. They don't expect to lose much. And I think there is a disagreement with the OCC and the Fed that you have to have a minimum level of reserves, even though your expectations are lower. So it's been a hard pill to swallow, but the regulators are the referee and they are the boss. And if they want you to have reserves above peer level, then it has to get done. And that has been really the lesson learned on this case. And certainly the company took their medicine on March 30 or on January 31st. The problem has been the market lost confidence in the management team and the lack of communication. And I think we all felt that perhaps this could have been handled earlier and differently with a little more warning, a little more explanation than what we had. And, that led to just a lot of question marks. And of course, there were a few people let go on the management team that occurred before the 31st of January. And that did not fully come out when the company initially disclosed their earnings for Q4.
Regulatory requirements are one thing, but as you mentioned there's also now these interest rates rising, and that's putting pressure on some banks' balance sheets. But another thing that I've heard of that's quite an exposure problem for US banks at the moment is commercial real estate and those valuations falling. So how's that playing out in the regional banking sector right now?
Well, commercial real estate's a big topic. So if we drill it down, there are 5 or 6 food groups in commercial real estate. Multifamily is one, office is another, retail, industrial, hotels. There are self-storage and other smaller areas. But within the multifamily, which is really where NYCB has done a predominant amount of their lending, there have been some very strong rents around the country, and those rents have begun to peak in this past year. More specifically, in New York City, there has been rent control laws passed in 2019, which limit the amount of rent you can increase and also limit how you can take an existing building and renovate it. for decades, the landlords in the New York City area have taken old buildings, renovated them, and then moved units out of rent control. That is a big business, requires a lot of capital, a lot of lending. It's a great business. The New York State changed the rules on what you can do on renovating those apartments to keep the supply of rent control units sort of fixed and not declining. So that renovation game came to a halt. And that's less of the problem for NYCB in terms of problem loans. It's really that the cash flow on those units cannot be increased. And therefore, you are kind of fixed with a 2% per annum increase. And it's just a different game. And then you layer on higher interest rates to move from a zero Fed funds environment in 2020 and 21 and go back to 5.33, which is where we found ourselves by last year. Then it just becomes a whole different rate environment for those loans to reset. Those are typically 5-year loans. And when the loans renew this year, next year, and in 26, you're facing a higher interest rate environment. So again, like I mentioned, the debt service coverage is not as good on anything. Now, there are a few office real estate loans that the company has. They did have a couple hiccups that were disclosed in third quarter of last year. I think those were being handled. We expected there to be more loss content reserved for. They did that in the fourth quarter. I think that's being cited as some big problem for them. I don't really think it is. I do think that the same thing goes with the office book, is that you do have to criticize the loans, put more reserves against it, and really plan for those higher interest rates. But again, the issue has been the loans have not gone bad from a standpoint of defaulting. They simply are higher risk grade. They have stress on them, and it's a tougher cash flow for the borrower when they renew. And some of these renewals are still years away, but you have to properly account for them on your books in terms of being either a criticized loan or, more importantly, having the reserves against them. That's really what's happened here. But again, I think that the broader commercial real estate in America has a lot to do with location and where you are and exactly what type of loan you have, and has the borrower defaulted. There are some loans that are performing beautifully today and have no issue. And yes, they're commercial real estate, but the borrower is doing just fine. So it really does depend on what is there. We think that companies generally in the US have been pretty tough on themselves in terms of how they've risk graded. I think NYCB was doing some of their risk grades. I just think it wasn't tied to higher rates and the stress testing that the OCC wants to do. It's a very rigorous program that a large bank above 100 billion has to do. And I think that that was sort of, again, moving from the minors to the majors in sports terms is where NYCB just was not ready for prime time. I still think they could have got there. I still think they will get there. It's just going to happen with new leadership on the board, certainly new capital that's come in today.
Speaking of those major league banking teams, the likes of JP Morgan, as you've mentioned, hold a lot more market share than these hundreds, if not thousands, of regional banks in the US. And Jamie Dimon came out very recently saying that large banks and small banks are allies, not enemies. Do you think that the big players in this banking game should be doing more to help those many smaller regional banks? And if so, what could they actually do?
No, I don't think so. I think you have to have a little bit of a separation of church and state. I mean, they are allies, but I do think that they should kind of stay out of each other's way. The big banks tend to be working for larger corporate customers, providing different layers of risk. The midsize and community banks tend to be small business lenders. They're out there in the community supporting baseball games and little leagues and doing a lot of working with the individual businesses who really get to know their customer. It's not that the big banks can't do that. They just can't really get down on grassroots level to do it the same way that a community bank does. There's a certain level of advice and handholding that a small business wants. And it's hard to do that through Bank of America and JP Morgan. They do it, and they do have, thousands of customers who are small businesses that they support. I just think that it's a better business model for the community banks. They tend to give a better sort of kid glove service, much more of a localized approach to really know the borrower. I think what has happened over time is the big banks are constantly having their lenders being promoted up the food chain because a good lender, he or she is going to move up because if they're successful, they're going to be promoted higher up in the organization. It's just how it works at a Bank of America or JP Morgan. It's no fault, it's just how they're structured. A smaller community bank is much more laser focused and is out there in the community working with those customers. I also think that technology has leveled the playing field so that some of these technological advances that were bragged about years ago at the old Nations Bank, now Bank America, at JP Morgan and Bank One, where Jamie came from, those technologies have come down to the small banks. They can offer excellent treasury management services and excellent products. So I think that the large banks, they really need to stay kind of in their lane, working with larger customers, and let the midsize and small banks working with the small customers. And small banks are still very much needed in the U.S. because that's the engine of growth. That's where the jobs are created in the country, and so there's still very much a place for them.
Reflecting on the US banking sector exactly 1 year post the Silicon Valley Bank collapse, Chris, how would you describe the state of the regional banking system right now?
I think it's very healthy. The one point that I have seen across my whole career, and I've been covering banks since 1992, is that leverage is radically different today. Leverage in the lending space is done at about 60% or less loan to value. We were seeing 95 to 100% all day, every day in 2006 and 7 that led into the 2008, 9, and 10 crisis. That leverage, way too high, created a lot of losses, a lot of need for capital, many bank failures. It was not a fun time. Fast forward to today, leverage is considerably less. There are real equity in deals, deals being loan deals. And I think that the borrowing and the loss content is dramatically different. It's much less. So, sure, New York Community may have loans that are not worth par, but if they've lent 58 cents on the dollar, they've got a lot of equity to work through. And so, if you have a loan that maybe is a 50% loss, if you only have 40%, if you have 40% equity, you have a much lower loss content. You can solve that problem much better than when you lent 95 cents on the dollar and we're stuck having a big write-off. I just think the level of losses in the industry are substantially less. And so far, the net charge-offs bear that out. But the banks do have to reserve. They have to be careful on capital. We need more liquidity. Liquidity was the problem with the Silicon Valley Bank last year. They weren't prepared. And obviously, they had some deposit issues too, which we can get into. I think the deposit issues still exist in the system, but it's not at New York Community. It's much more at the biggest banks who still have a lot of clunky, uninsured deposits. And we haven't solved for that yet in the country.
So I'm going to take from that that you still think that there is a lot of deposit flight risk out there right now.
Well, there is at big banks because the big banks have all of the big uninsured deposits. The uninsured deposits at the smaller companies and even the mid-sized companies is actually very, very modest. You look at New York Community, they have 23 billion out of 83 billion that's uninsured. They have enough liquidity to cover that. I think there was a lot of false information that there were runs at NYCB that really wasn't true. There was a run of confidence on the story from the investor and stock perspective. That's what happened. It wasn't a depositor issue, but we haven't really adjusted deposit insurance. We haven't created a supplemental and deposit insurance scheme in the US. I wish we would. I think that would be really good. We used to have a tag program for transaction account guarantees in 2009. That was very healthy. Businesses would love to have that, but we have not done that. And it looks like we've missed our opportunity. Congress is moving on to other things, and so we'll do without it. But it's still a risk in the system here as we reflect on what happened a year ago.
Do you want me to tell you a really scary fact, Chris?
Sure.
We do not have a deposit insurance scheme at all in New Zealand.
Well, maybe if you have more capital against banks and better information with the regulators, there's a way to do that. So we've had our fits and starts in the U.S. with deposit insurance. That's for sure.
Thank you so much for your time, Chris. Always appreciate your insights.
My pleasure. Have a great day.
Now, someone who came out scathing about Silicon Valley Bank and the others last year was the chief executive of the sixth biggest US bank, PNC. William Demchak is still at it, saying in his bank's latest annual report that those banks' issues were not the result of systemic problems, but they have caused a crisis of confidence in regional banks. So now depositors apparently trust the bigger banks more. For that reason alone, he's focused on making PNC bigger, because in his mind, more scale means more safety. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.